Ever stop to think about just how much money is zipping around the world every single day?
It's truly staggering. Trillions.
Right. And it underpins pretty much everything. So today, here on the Deep Dive, we're tackling the, well, sometimes head-scratching world of financial markets and institutions.
It can definitely seem complex from the outside.
Absolutely. You've given us a fantastic range of material, and our job is really to boil it down, find the essentials for you.
Yeah, cut through some of that complexity.
Exactly. We're going to explore, well, everything from how your everyday stock trade actually happens to the finer points of global finance. We've got info here on secondary markets, interest rates, bonds, derivatives, even the regulator.
Rule makers, yeah.
So our mission today is pretty straightforward. Unpack the core ideas, see how these different pieces fit together, and hopefully give you a clear, engaging overview.
And what's really remarkable, I think, is that this constant flow of money isn't just numbers on a screen. It's genuinely the engine, you know? It channels savings into the investments that drive economic growth.
That's a great way to put it, an engine.
And to really get it, we need to look at the basic structure, the financial system itself. Our sources show it clearly as a network. It connects savers, those with extra funds, to those who need funds for investment.
So the people with money and the people who need money to do things.
Precisely. And that network includes the markets themselves, the intermediaries like banks, insurance companies, and of course the regulatory bodies keeping an eye on it all.
It's like a massive circulatory system for the economy, yeah. And right away, the material you sent highlights a really fundamental split, primary versus secondary markets. Let's try and break that down.
Good place to start.
So the primary market, as I understand it, is where new stuff gets sold for the first time. Like when a company does an IPO, issues shares initially, or the government sells new bonds. That's to raise capital, right?
Exactly. It's the first sale. And the sources mention two main ways this happens. There's the direct route, like a public offering where, anyone can theoretically buy in. And then there's the indirect way, often involving investment banks, the underwriters. They help the company or government sell those securities.
Right. The underwriters take it on and sell it out.
That's the idea. So the primary market is where that fresh capital is actually born. But what really makes the whole system work day to day and provides that crucial liquidity is the secondary market.
Ah, okay. So that's different. How?
Well, the secondary market is where securities that have already been issued get traded between investors. Think of the stock exchange, like Borsa Istanbul or the New York Stock Exchange. That's the secondary market in action.
So used securities, basically, not brand new.
Kind of, yeah. And the key thing is liquidity. If you buy a share, the secondary market means you can usually sell it again pretty easily if you need cash or want to reinvest elsewhere.
Which makes people more comfortable buying in the first place, I suppose.
Exactly. That ease of selling creates demand for the new securities in the primary market. Plus, the secondary market is where prices are constantly being set. Supply and demand, reacting to news. It's a continuous price discovery mechanism.
Okay, so primary, new issues, raising capital. Secondary, trading existing stuff, liquidity, finding the price. Makes sense. Now, the sources introduce dealers and brokers in these secondary markets. They both help connect buyers and sellers.
They do, but in slightly different ways. A dealer basically trades for their own account. They buy securities, hold them in inventory, and hope to sell them at a higher price.
So they're taking on the risk themselves.
Correct. Their profit comes from the spread, the small difference between the price they buy at, the bid price, and the price they sell at, the ask price.
Okay. And brokers.
Brokers act as agents. They work for their clients, executing trades based on the client's instructions. They don't hold inventory themselves. They just facilitate the trade and earn a commission for that service.
Got it. Dealer, their own money, profit on the spread. Broker, client's money, earns a fee. Both connect buyers and sellers, though.
Absolutely essential roles in making the market function smoothly.
Okay. Let's switch gears slightly. Money markets versus capital markets. This seems to be about timing, how long the investments last.
Exactly. The dividing line is the maturity of the financial instrument, usually debt. Money markets deal with short-term borrowing and lending. Think instruments maturing in 1 year or less.
Like what?
Things like treasury bills, short-term government debt, or commercial paper, which is like an IOU from a large company. Short-term.
Okay, short-term is money market and capital markets.
Capital markets are for the long haul. Instruments with a maturity of more than 1 year, or things like stocks, which technically have no maturity date, they represent ownership.
So long-term government bonds, corporate bonds, and stocks live in the capital market.
Precisely. And what's really interesting is how they're linked. Funds flow between money and capital markets all the time.
What is that?
It's driven by interest rates. If you can get a better return, adjusted for risk, in the short-term money market, funds might shift there from longer-term investments, and vice versa. Interest rates really act as a kind of regulator or traffic signal guiding where the money goes.
Makes sense. And banks play a role in both.
And yes, banks are major intermediaries operating across both markets, facilitating borrowing and lending for all sorts of different needs and timeframes.
Okay. Short-term, money market. Long-term in equity, capital market. Linked by the flow of funds chasing returns, guided by interest rates. Speaking of which, interest rates get their own section. Their role in market equilibrium sounds like basic supply and demand.
That's a perfect analogy. It really is supply and demand, but specifically for loanable funds, money that can be borrowed. Financial market equilibrium is just the point where the amount people want to lend match the amount people want to borrow.
And the interest rate is the price.
Exactly. The interest rate is the price of borrowing money. So the sources explain, when interest rates go up, people are generally more willing to save and lend because they get a higher return. So the supply of loanable funds increases.
Right.
But on the flip side, higher interest rates make borrowing more expensive for businesses wanting to invest or individuals wanting loans. So the demand for loanable funds tends to decrease.
So supply goes up, demand goes down when rates rise.
Correct. The equilibrium interest rate is simply the rate where those two curves intersect, where supply equals demand. That's the rate that clears the market.
The sweet spot where lenders and borrowers agree on the price. Got it.
Okay, now let's jump to foreign exchange markets. Trading currencies, what makes those exchange rates tick?
Exchange rates. Yeah, there are a lot of factors, as the sources detail. Think about what brings foreign currency into a country.
Like selling goods abroad, exports. Exactly, exports, tourism, money sent home by workers living abroad, remittances, and foreign investment coming in. All these things increase the supply of foreign currency and the demand for the local currency. That tends to push the local currency's value up.
Makes it stronger.
Right. And the opposite is also true. Things that cause money to flow out, like buying lots of imports, investing abroad, paying interest on foreign debt, those increase demand for foreign currency and the supply of the local currency, which can weaken it.
So imports make the currency weaker, potentially.
Potentially, yes. And beyond those basic flows, the sources highlight other big influences. The overall economic health and political stability of a country matter a lot.
Of course.
Differences in interest rates between countries are huge. Money supply, inflation, even the amount of foreign exchange reserves a country holds, they all play a part in determining the equilibrium exchange rate.
So a stable, growing economy with decent interest rates probably has a stronger currency than one with, say, high inflation and political uncertainty.
Generally, yes, though it's always a complex mix. The sources also mention something called the real effective exchange rate, or RER. That sounds a bit more involved.
Yeah, what's that about?
It's a more sophisticated measure. It doesn't just compare one currency to another, like the lira to the dollar. It looks at a country's exchange rates against all its major trading partners and weights them based on how much trade happens with each partner.
Okay, so it's weighted by trade volume.
Right. And crucially, it also adjusts for differences in inflation rates between the home country and those trading partners.
Inflation adjusted. Why is that important?
Because it gives a much better picture of a country's actual international competitiveness. Are its goods really getting cheaper or more expensive relative to others on the global market once you account for both currency moves and price changes? The sources even show a formula for how it's calculated. It's a way to see beyond just the nominal rate.
Right, a broader, more real picture of competitiveness.
Yeah.
Makes sense. Now, why does money, or capital, move across borders in the first place? What attracts it?
The sources point to three main drivers, really. First, the potential for good returns on investment. If a country looks like it has strong growth prospects, good business opportunities.
Money flows in.
Yeah. Second, perceived creditworthiness or trustworthiness. If a country is seen as stable, manages its finances well, has a good credit rating, investors feel safer putting their money there.
Less risk.
Exactly. And third, real interest rates. That's the interest rate after you account for inflation. Higher real rates in one country compared to another can attract capital seeking better returns. Investors are constantly weighing these things up.
Good prospects, reliability, and better inflation-adjusted returns. Seems logical. Okay, now the deep dive gets really specific, focusing on markets and instruments right here in Turkey. Let's start with the TCMB Interbank Money Market. TCMB being the Central Bank of Turkey, what's its purpose?
Yeah, this is interesting because it shows the central bank's direct hand in managing liquidity, basically, the amount of cash available within the banking system. The interbank money market was set up to manage this liquidity and help guide the economy.
How does it do that?
The TCMB sets daily upper and lower limits on the interest rates for overnight borrowing between banks. They try to keep most transactions happening within that range, that corridor. If rates start going too high because banks are short on cash,
TCMB steps in?
yes, they can inject liquidity, maybe through repos. If there's too much cash and rates are falling too low, they can absorb liquidity, perhaps by selling bills.
Okay, so they actively manage the short-term money supply.
They do, and it's particularly important for smoothing out bumps caused by, say, Treasury operations. Like when the Treasury pays back a lot of domestic debt, suddenly there's a flood of cash in the system.
Which could push rates down too much.
Right. Or when the Treasury holds a big bond auction, pulling cash out of the system, which could cause rates to spike. The TCMB uses this market to counteract those effects and keep things stable. And because this market directly influences other short-term rates, it's a key indicator for the whole financial system.
So a hands-on approach to keeping short-term rates stable. Next up, the BS bonds and bills market. BS being Borsa Istanbul. Why was this market created?
The main goals were severalfold. First, create a more efficient way to distribute fixed income securities, bonds, and bills among financial institutions. Second, establish a transparent secondary market where these could be traded after issuance.
Like we discussed earlier, liquidity and price discovery.
Exactly. And third, make it easier to do repo and reverse repo transactions in a clear, regulated way.
And has it achieved those goals?
The sources suggest yes. Since it was set up, there's been more secondary market trading in bonds and bills. It's easier to access, transaction costs are lower, and there's a settlement guarantee, which is really important.
What drives the prices and rates in this market?
Well, it's heavily influenced by what's happening elsewhere. Government borrowing needs are a big one. More borrowing usually means higher rates. Macroeconomic factors like inflation, growth prospects.
Usual suspects.
Right. Also, the TCMB's open market operations have a direct impact, especially on repo rates, government debt levels, the exchange rate, overall market liquidity, even just the specific funding needs of the institutions trading in the market. They all feed into the prices and yields you see there.
So it's the main hub for debt trading, reflecting the broader economy and central bank actions. Okay. Then there's the Istanbul Gold Exchange. Gold is obviously important in Turkey. What's the exchange's role?
Yeah, Turkey has significant gold holdings, both official and private. The exchange was set up to try and integrate that gold potential more formally into the economy, make it easier to export gold, develop gold-based financial products.
Bring it into the regulated financial system.
Exactly. And gold prices themselves, as the sources note, are influenced by a mix of global and local factors. Global supply and demand, geopolitical events. Gold often acts as a safe haven, so prices might rise in crises. Locally, the USD-TRI exchange rate is critical since gold is priced internationally in dollars. Seasonal effects, like demand for weddings, play a role. And, of course, how attractive other investments are. If stocks or bonds are offering great returns, demand for gold might dip and vice versa.
So global trends plus local factors like the exchange rate and seasonality. We also see mentions of the free foreign exchange market and the free gold market. These sound less formal. OTC markets.
That's right. The free foreign exchange market is over-the-counter, meaning trades happen directly between banks and other authorized institutions, not on a centralized exchange. Prices are driven by the immediate supply and demand for physical foreign currency notes.
So very sensitive to immediate cash needs.
Very sensitive, yeah. The sources mention things like tax payment days or treasury auction settlements. Times when cash might be tighter or looser can cause noticeable moves in the lira's value in this specific market segment.
Okay. And the free gold market.
Similar idea, but for smaller gold transactions below the minimum size for the main Istanbul Gold Exchange. It's unregulated, deals are negotiated directly, prices are mainly driven by international gold prices in USD, the local USD-TRI rate, and seasonal factors, especially tourism impacting local demand.
So these free markets are more direct, perhaps more volatile based on immediate local conditions. Finally, on the Turkish markets, we have the repo and reverse repo market, linked to the biased bonds and bills market. Can you quickly explain repos again?
Sure, a repo or repurchase agreement is essentially a short-term collateralized loan. One party sells securities, often government bonds, to another party, but agrees to buy them back at a slightly higher price on a specific future date, often just overnight.
So the securities are like collateral for the loan.
Exactly. The difference between the selling price and the repurchase price is the interest on the loan. A reverse repo is just the other side of that same transaction, buying securities with an agreement to sell them back. These are absolutely vital tools for banks managing their daily cash needs and for the central bank conducting open market operations to manage overall liquidity and influence short-term rates.
Okay, short-term borrowing backed by securities. Crucial plumbing for the financial system. Now let's zoom in on the TCMB, the Central Bank of Turkey. Its role as a financial authority seems vast.
It really is. The TCMB is the primary financial authority overseeing and regulating the system. Its functions are incredibly broad. Starts with the basics, issuing banknotes, controlling money circulation.
Physical cash.
Right. But much more significantly, conducting open market operations, buying and selling those government securities we just talked about to manage the overall volume of lira in the economy. That's a key monetary policy tool. Ensuring financial stability is a huge one. Monitoring markets, intervening in money and FX markets when needed. Managing the country's gold and foreign exchange reserves. Setting rules for bank deposits. Even acting as an advisor to the government on economic and financial matters.
That's a massive portfolio. Who makes the key decisions within the TCMB?
The sources highlight two main bodies. The Monetary Policy Committee, or MPC, is probably the most well-known. It's responsible for the big strategic decisions, setting the overall monetary policy stance, inflation targets, deciding which policy instruments to use.
Like interest rates, reserve requirements, those open market operations.
Exactly, and decisions on foreign exchange operations. Then there's the governor's office, which handles matters outside the MPC's direct mandate, issuing regulations on other aspects of the bank's operations.
So MPC for the big policy levers, governor's office for other operational stuff. Okay. Now, risk. You can't talk finance without talking risk. The sources focus on banking risks in Turkey, specifically credit and liquidity risk.
Yeah. Those are fundamental. Credit risk, the risk that borrowers won't repay their loans, is always there, and Turkish banks certainly have experience managing it. But liquidity risk seems to have become a bigger focus, especially given Turkey's economic environment.
Why is that?
Well, the sources point to a preference among depositors for short-term accounts, while investors, perhaps due to inflation worries or general uncertainty, might seek longer-term investments. This creates a potential mismatch for banks.
Their funding is short-term, but their lungs might be long-term.
Exactly. That makes them more sensitive to liquidity, risk the danger of not having enough readily available cash to meet immediate obligations if depositors suddenly want their money back. Past crises, like the one mentioned from 1998, also made international investors more cautious, which in turn encouraged Turkish banks to hold more liquid assets and maybe slow down lending somewhat.
Managing that time mismatch sounds like a constant juggling act. The sources also mention moral hazard related to 100% deposit insurance. What's the issue there?
It's a classic dilemma in banking regulation. If depositors know all their money is guaranteed, no matter how risky the bank is, they might have less reason to choose a safer bank. They might just go for whoever offers the highest interest rate.
Even if that bank is taking big risks to offer that rate.
Precisely, and the banks themselves might feel freer to take on more risk, knowing their depositors are protected by the government guarantee. So the insurance, while intended to protect savers and prevent bank runs, could unintentionally incentivize riskier behavior by both parties. That's moral hazard.
A tricky balance. So what is needed for a healthy banking system, according to the sources?
Several key things are emphasized. First, effective and independent supervision and regulation. That independence is crucial. Second, adopting international standards and best practices for supervision. And third, actively develop it and using methods to reduce the financial risks banks face.
Strong oversight, global standards, proactive risk management. Makes sense. And for individual banks, what constitutes good management? Asset liability management, ALM, seems key.
Absolutely. Good ALM is critical. The sources list several elements: having clear, well-defined policies for managing assets and liabilities, dedicated ALM committees to oversee this, using robust planning models that consider both liquidity needs and sensitivity to interest rate changes.
So, planning for different scenarios.
Right. Plus, accurate and timely reporting is essential for informed decisions. balancing short-term needs with long-term strategy and coordinating funding management effectively. It's about a holistic, forward-looking approach.
Sounds comprehensive. The sources also stress cost control for banks, especially when interest rate margins are tight.
Yes, when the gap between lending rates and deposit rates, the net interest margin shrinks, banks have to focus hard on efficiency to stay profitable. Since they can't always control market interest rates, managing their own operating expenses becomes vital.
How can they do that?
The sources suggest things like collaborating on certain back-office operations, investing in more efficient alternative distribution channels like digital banking, and crucially, developing non-interest income sources fees for services, etc., to supplement thinning interest margins.
Efficiency and diversification of income. Got it. Okay, let's shift to alternative financing methods. Financial leasing, factoring, forfeiting. What's financial leasing?
Financial leasing, or just leasing, is basically a way for a company to get the use of an asset without buying it outright. The leasing company buys the asset and then rents it to the lessee for a set period in return for regular payments.
What kind of assets?
Pretty much anything movable or immovable, except intangible things like patents, so machinery, vehicles, computers, medical equipment, even buildings. Ownership stays with the leasing company during the lease term.
What are the advantages for the company using the asset?
The big one is preserving working capital. You don't have a huge upfront cost, you just make regular payments. It helps cash flow. Plus, the sources mention potential tax advantages in Turkey, like reduced VAT rates on certain types of investment goods and commercial vehicles when leased.
So better cash flow and maybe lower taxes. Who can use leasing?
Pretty much any legally competent person or entity, sole traders, partnerships, companies, professionals. It's quite accessible.
Okay. Next, factoring. This sounds like it deals with money owed to a company.
Exactly. Factoring is a way to finance short-term trade receivables, the invoices a company has sent out but hasn't been paid for yet. It involves the seller, the customer, the factoring company, the factor, and the buyer, the debtor.
How does it work?
Essentially, the factor buys the seller's invoices, usually at a discount, providing the seller with immediate cash. But factoring often involves more than just finance. The factor might also take over managing the receivables, handling accounting, sending reminders, collecting the payments, even pursuing legal action if needed.
So the seller gets cash quickly and offloads the collection hassle.
That's the idea. The seller gets improved cash flow, simplifies their admin, and sometimes can even transfer the risk of the buyer not paying to the factor. The factor charges a fee for these services, typically a percentage of the invoice value.
Are there different kinds? The sources mention full-service factoring.
Yes, full-service factoring includes the whole package, managing the receivables, handling collections, providing the cash advance, and taking on the credit risk. The factor assesses the creditworthiness of the seller's customer, sets limits, and within those limits, guarantees payment even if the customer defaults.
That sounds very useful for managing both cash flow and risk. What about the costs involved in factoring?
There are typically two main cost components mentioned. There's the factoring fee, which is like a commission charged on the value of the invoice for the management and collection services. And if the seller takes an immediate cash advance against the invoice, there's usually an interest charge on that advance, similar to a loan.
So, a service fee and interest on the money advanced. Makes sense. How does factoring help with continuous cash flow?
By guaranteeing and managing the receivables, factoring provides a predictable inflow of cash, smoothing out the bumps that can come from waiting for customers to pay. This regular cash flow helps businesses manage their day-to-day operations, pay suppliers, and plan more effectively.
Okay. The last one is forfeiting. How's that different?
Forfeiting is also about financing trade receivables, but it usually deals with medium to long-term receivables arising from export-import transactions. And critically, it's done on a non-recourse basis.
Non-recourse meaning?
Meaning the seller, the exporter, sells the receivable like a promissory note or bill of exchange from the importer to the forfeiting institution, the forfeiter, at a discount, and has no further liability if the importer fails to pay later on. The forfeiter takes on all the risk. It's often used for financing exports of capital goods or large projects.
So longer-term international trade, and the seller walks away with cash and no risk.
Got it. Okay, brief mention of insurance companies next. What's highlighted? Just the importance for insurance companies of having the right service units set up and staffing them with qualified personnel. It also notes the specific requirements for managers and experts in intermediary institutions, education, experience, licenses from the SPK, underlining the need for professionalism in the sector.
Qualified people, proper structure, essential for trust. Now, equity-based instruments. Income partnership certificates, GOS, what are they?
GOS are securities issued by public entities in Turkey. They let investors participate in the revenues from specific infrastructure projects, think bridges, highways, power plants. You buy a certificate, you get a share of the income generated.
Interesting. Are they regulated like normal stocks or bonds?
Well, that's a key point the sources make. There aren't specific regulations for GOS under the Main Capital Markets Law, SPK, or the Turkish Commercial Code, TTK. Their legal basis comes from a different law aimed at encouraging public investments and the Public Partnership Fund regulation.
So, a slightly different legal footing. Are there downsides mentioned?
Yes, a few potential issues. Often the government guarantees a return above inflation, which can conflict with the aim of providing affordable public services they might have to raise tolls or fees to meet the guarantee.
Right.
Also, the money raised needs to be invested quickly. And for very long-term projects, it can be hard to generate enough revenue within the certificate's lifespan, possibly requiring treasury top-ups or new GOS issues to pay returns. Plus, the lack of standard SPK regulation might imply different investor protection levels. And importantly, GOS holders don't get any ownership or control over the actual infrastructure.
Sounds like some potential structural challenges there. Okay, next, asset-backed securities, VDMK. What's the concept?
VDMK are securities backed by a pool of underlying financial assets, typically loans or receivables. Think mortgages, car loans, credit card debt. These are bundled together, and securities representing claims on the cash flows from that pool are sold to investors.
So bundling up debt and selling it on, what are the rules for issuing them in Turkey?
They have to be registered with the SBK if offered publicly. The total value of the VDMK can't exceed 90% of the value of the underlying receivables pool at the time of issue. They can be sold at a discount or pay periodic interest, and they're freely tradable. Crucially, the issuer must keep the underlying assets separate from their own accounts and provide regular reports to the SBK on how those assets are performing. The SBK can also audit them.
Segregation and reporting seem key for transparency. What about real estate certificates? What do companies need to do to issue those?
There are specific hurdles. The issuing company needs to prove it has successfully completed a similar real estate project within the last 5 years. They need to demonstrate professional and technical capability. Their obligations under the certificate, including any penalties, must be guaranteed by a bank. And like VDMK, the certificates must be registered with the SBK. It's about ensuring the issuer has a track record and financial backing.
Safeguards for investors in property projects.
Okay.
The discussion then turns to dematerialization, getting rid of paper certificates.
Exactly. Dematerialization means moving from physical share certificates and bond documents to electronic records. In Turkey, this is mandated by the Capital Markets Law and related regulations.
Who keeps these electronic records?
There's a central organization called the Central Registry Agency, or MKK. It's a private entity but supervised by the SPK. The MKK electronically tracks ownership of capital market instruments and the rights associated with them, replacing the need for paper. Records are held by issuer, intermediary, and the owner.
So it's all digital now. What does this mean for proving ownership or transferring shares?
Proving ownership to third parties relies on the date the MKK was notified of the transaction. When shares change hands, the MKK's records are the basis for updating the company's official shareholder list, no separate application needed. And investors can request a status document from the MKK for a fee showing their current holdings.
Sounds much more efficient and secure than paper. Let's look back briefly at the history of capital markets in Turkey. Ottoman and Republican era is mentioned. What happened early in the Republic?
Well, the sources note it's useful to see it in two periods. Early in the Republic, a 1923 decree aimed to nationalize exchange operations, requiring participants to be Turkish. Then the 1929 Securities and Exchange Markets Law came in. But interestingly, it kind of slowed things down by only allowing trading in listed securities.
Limiting the scope.
Right. So significant development didn't really kick off until the 1960s. There was some private bond trading in the 50s, but volumes were tiny. The 60s saw things like savings bonds for state employees and Liberty bonds offered to the public, which helped stimulate activity again.
So a slow start after initial regulation, then a pickup later. Now, stock valuation. The sources list several concepts: liquidation value, going concern value. What are these about?
These are just different ways to think about what a company's stock might be worth. Liquidation value is the bare minimum what's left for shareholders if you sell everything off and pay all debts, often seen as a floor price. Going concern value is the opposite the value if sold as a functioning business, often seen as an upper limit or target. Net asset value is just the book value from the balance sheet assets minus liabilities.
And alternative income value.
That's about opportunity cost.
Yeah.
What could you earn if you put the same money elsewhere, like in a safe government bond or bank deposit? Helps you judge if the potential return from the stock is worth the risk.
Different angles on value. Helpful context. Now, issuing shares again.
Oh.
Paid in, Bedelli, versus bonus Bedelsize shares. The difference.
Paid in, or Bedelli, shares are issued when new money comes into the company, either at the start or during a capital increase where existing shareholders pay for new shares, a rights issue, or they're offered publicly.
Ooh.
Cash comes in.
Okay, and bonus shares.
Bonus or Bedelli's shares are different. They're created by capitalizing the company's existing reserves like retained earnings or revaluation surpluses. Existing shareholders get new shares proportionally for free. No new cash enters the company. It's more like an accounting adjustment and increases the share count.
Paid in new cash. Bonus using existing reserves. Got it. What about voting preferred shares? A YHS. They sound complex.
They have some specific rules. Their total value can't exceed 75% of the company's paid-in capital. Issuance requires specific provisions in the company charter, board approval, and they must offer a preferential dividend and optionally a liquidation preference. The dividend preference rate has to be stated.
So they get paid dividends first.
They get the regular dividend plus a preferential dividend. But there's a catch for the company. If they don't pay that preferential dividend, they face restrictions. Can't allocate profits to reserves, can't carry profits forward, can't distribute profits to management or others.
Serious consequences.
Yes. They can also have priority in getting capital back if the company liquidates, if the charter allows.
Oh.
And importantly, if profits aren't distributed for 3 consecutive years or 1 year without regulatory approval, these preferred shares automatically convert into common shares with full voting rights.
Wow. Okay. So they have benefits, but also a conversion trigger if things go wrong. Do they get rights and capital increases?
Generally, yes. Both OYHS and common shareholders have preemptive rights to maintain their stake, unless the charter says otherwise. Bonus shares can be issued with voting rights, but the OYHS preferences don't apply to those bonus shares.
A unique type of share with specific rights and triggers. Now, bond issuance. General requirement seems to be SPK registration.
Yes, for most issuers, excluding the main government budget administrations and the TCMB bonds, have to be registered with the SPK before being offered. Even the exempt ones need to inform the SPK after issuance.
What does the SPK look for?
If it's a public offering, they review the prospectus and other documents to ensure adequate and accurate disclosure for investor protection. They can refuse registration if the info is insufficient or misleading. For private placements, selling to a few sophisticated investors, they check the information is complete and accurate, including who the buyers are.
So disclosure and investor protection are key. What about cash convertible bonds?
These are bonds, usually with a maturity of at least 2 years, that give the holder an option to convert them back into cash before the final maturity date, perhaps after a set period. The terms vary, but it offers some flexibility for the investor to get their money back early, potentially with accrued interest. Redemption at maturity usually follows a plan up to 5 years.
Bond safety with an early exit option.
Interesting.
Okay, let's talk public debt management. What are the government's main goals here?
The sources state the objectives are a sustainable, transparent, and accountable borrowing policy aligned with monetary and fiscal goals. The core aim is meeting financing needs at the lowest possible cost for a given level of risk, considering both domestic and international markets.
And the guiding principles.
Liquidity, always being able to pay debts on time. Transparency, making the borrowing process and debt levels public. And simplicity, aiming for clear, understandable debt instruments and strategies.
Low cost, managed risk, clear process. Seems sensible. What are the main risks the government faces when managing its debt?
Several key ones. Refinancing risk, not being able to borrow again easily when old debt matures. Interest rate risk, rising rates, increasing borrowing costs. Exchange rate risk for foreign currency debt. A weaker local currency increases the repayment burden. Operational risk, problems with systems or processes. And credit risk or counterparty risk, the risk that institutions the government deals with might fail.
A lot to keep track of. The sources mentioned changes in borrowing limits. What changed?
The main change highlighted was shifting the limit calculation from net domestic borrowing to overall net borrowing. Also, the potential increase allowed above the initial limit was reduced from 15% down to 5%, with another 5% possible with Council of Ministers approval. And certain special domestic borrowing instruments previously excluded are now included under the limit. Seems like a move towards tighter, more comprehensive control.
Okay. How are government bonds offered to the public?
Through a public offering method, using banks and intermediaries. The goal is to broaden the investor base, making government debt accessible to individuals. The Treasury sets the terms amount, maturity, rate, commission, sales period. During periods with a market maker system, only those designated banks could handle these public offerings.
Making it easier for individuals to buy government debt, and those ISIN codes for DBS.
They're standardized identifiers, TR for Turkey, a letter for security type, T-bond, B-bill, the maturity date, DDM-MYY, and a final letter for currency and type, like T for full TL principal and coupon, or P for foreign currency principal, ensures unique identification for trading and tracking.
A unique code for every bond. Lastly, on public debt, the market maker system, what was that about?
It was an agreement between the Treasury and selected banks. These banks had obligations. Provide continuous buy-sell quotes for DBS, participate actively in auctions, support secondary market liquidity. In return, they got privileges. Primary dealer status, access to special central bank facilities. Agreements usually lasted a year, renewable if criteria were met. It was about ensuring a liquid and active market for government debt. Successful debt management overall needs technical skill and independence from political pressure.
A partnership for market liquidity. Got it. Now, initial public offerings, IPOs of stocks. The process starts with optional pre-demand collection.
Yes, that's right. Before the formal SPK registration, the company and its underwriters can test the waters. They distribute a preliminary document with a potential price range to gauge investor interest. It's non-binding, but helps them estimate demand and set the final price.
Testing the appetite. Then come the official reviews.
Yes, dual reviews. The SPK checks the prospectus for full and fair disclosure, focusing on investor protection. They can reject the application if disclosures are inadequate. Borsa Istanbul, BSA, also reviews the company, does site visits, determines listing eligibility, and decides the appropriate market segment for trading. BST provides its opinion to the SPK for the prospectus.
So regulator checks disclosure, exchange checks suitability. What happens after approvals?
Promotion and sale. BS helps disseminate information about the company domestically and internationally. Once SPK registers the IPO, the shares are sold to investors according to specific SPK regulations on public offering sale methods.
A structured path from gauging interest to final sale. Let's look at Borsa Istanbul BS itself, its structure.
It has a General Assembly of members as the highest body. A board of directors manages it, including the chairman president. There's an audit committee, other committees, and the presidential office for day-to-day operations. The structure and rules are set out in BS's internal regulations.
Standard corporate governance structure. How does one become a BS member?
You need an SPK license first, then apply to BZEST. The board approves membership. Members get a certificate specifying authorized markets, which must be registered and publicly announced. Unauthorized use of the name Borsa is prohibited. Membership can be canceled or suspended, also publicly announced.
Regulated entry and transparent status. What about market manipulation? What's forbidden?
A range of activities aimed at distorting prices or creating false impressions. Things like wash trading, creating fake volume, artificially pumping or dumping prices, spreading false rumors, manipulating one security's price to affect another, coordinated buying selling to fix prices, making misleading statements. Basically anything that undermines fair and orderly trading.
Protecting market integrity. Makes sense. We touched on the Istanbul Gold Exchange again briefly, mentioning its legal basis.
Yes, established under the Capital Markets Law, Article 40A, and operates based on a specific regulation for precious metals exchanges from 1993.
Okay, now zooming out to futures markets. Their history seems rooted in agriculture, particularly in Chicago.
Absolutely. The Chicago Board of Trade, CBOT, founded in 1848, was pivotal. As agriculture and transport grew in the 19th century, Chicago became a major hub. But fluctuating supply and demand caused wild price swings for farmers and buyers.
So they needed a way to manage that price risk.
Exactly. Early informal agreements to buy-sell later at a set price forward, contracts evolved into the standardized, exchange-guaranteed futures contracts we know today. CBOT provided the central marketplace and the rules.
What are the core functions of these exchanges, beyond just being a place to trade?
They provide the physical or electronic marketplace. They ensure transaction and price information is public transparency. They establish and enforce rules for trading, clearing, settlement. And crucially, often through a clearinghouse, they guarantee the trades, reducing default risk.
Rules, transparency, risk reduction.
Mm-hmm.
How does risk management work in practice? The cotton farmer example.
Right. A farmer expecting a harvest in September worries the price might fall by then. In March, they can sell futures contracts for September delivery, essentially locking in a selling price now for their future crop.
Hedging their risk.
Precisely. If the price does fall, they lose on their physical cotton but gain on the futures contract, stabilizing their income. If the price rises, they gain on the cotton but lose on the futures. It smooths out the volatility.
A way to reduce uncertainty. The sources differentiate forwards, futures, options. Quick recap.
Forwards are customized, private agreements between two parties, traded over the counter, OTC. Futures are standardized contracts traded on an exchange. Options give the buyer the right, not the obligation, to buy a call or sell put at a set price by a certain date.
Custom versus standard versus right, not obligation. Got it. Key features of futures. Margin, limits.
Yes, very important. Margin, initial and maintenance, is a good faith deposit to cover potential losses. Daily price limits cap how much the price can move in a day, preventing excessive volatility. Position limits restrict how many contracts one entity can hold, preventing manipulation. Deliverable grades ensure the quality of the underlying commodity is consistent. Standardized features make trading efficient and reduce risk.
Safety mechanisms built in. Exchanges themselves are changing, more for-profit, mergers, electronic trading.
Definitely. Competition is driving change. Member-owned exchanges like CBOT and CME became for-profit companies to be more agile. Mergers like URX create scale. And electronic trading has largely replaced physical trading floors for speed and efficiency. VOB in Turkey started electronically. The goal remains secure, competitive trading.
Adapting to survive and thrive. What about clearinghouses? Their role.
Absolutely critical. The clearinghouse steps into the middle of every trade, becoming the buyer to every seller and the seller to every buyer. This process, novation, eliminates counterparty risk between traders. They guarantee settlement, manage margins, and ensure the market's integrity. They're the central counterparty, vital for safety.
The guarantor behind the scenes. Different types of exchange members.
Yes, roles vary. Commission brokers trade for clients. Floor brokers, less common now, traded in the pit. Proprietary traders use the firm's own capital. Clearing members handle settlement. Individual members might trade for themselves, but clear through a clearing member. Specifics depend on the exchange rules. For VOB, you needed an SPK license and BIS approval.
Different roles in the ecosystem. The margin example highlights leverage.
Yes, a key feature. A relatively small margin deposit controls a contract with a much larger underlying value. This magnifies potential profits and losses. It's why risk management is so crucial in futures. Margin goes to the clearinghouse, Takas Bank in Turkey, to guarantee the trade.
High potential reward, high potential risk. Okay, order types. More than just buy now.
Oh, much more. Competition has spurred innovation. Conditional orders, like example given, buy USD if it hits X, sell if it hits Y, cancel the other if one fills, allows complex strategies without constant monitoring.
Automated plans. What other types?
Market order. Execute now at best available price. Limit order. Execute only at your price or better. Gives price control but might not fill. Stop loss becomes a market order when a trigger price is hit. Limits losses. Fill or kill. Entire order executes immediately or it's canceled. Limit price order to open position. A limit order specifically to initiate a new trade at your desired price or better. Lots of tools.
Tools for precision and risk control. Now, options markets. The core idea.
An option gives the buyer the right, but crucially not the obligation, to buy a call option or sell a put option, an underlying asset at a specific price, the strike price, on or before a specific date, expiration. The buyer pays a fee, the premium, to the seller for this right.
Paying for the right, the choice. Key info in a contract.
Option type, European American. Contract type, corporate. The underlying asset, the strike price, the expiration date, and the premium paid.
European versus American option difference.
It's about when you can exercise. European, only on the expiration date itself. American, anytime up to and including the expiration date. More flexibility for American options. Doesn't refer to geography, just the exercise style.
Okay. And call versus put.
Call gives the right to buy. Put gives the right to sell. You'd typically buy a call if you think the price will go up. You'd buy a put if you think the price will go down.
Buy high. Call buyer hopes. Sell high. Put buyer hopes.
Yeah.
What happens at expiration?
The buyer has choices. Sell the option if it still has value, exercise it in profitable, price above strike for call, below for put, or let it expire worthless, losing the premium. The seller must fulfill the obligation if the buyer exercises, sell if call exercised, buy if put exercised. If it expires worthless, the seller keeps the premium as profit.
Buyer chooses, seller obligated. Options give rights, not obligations, to the buyer.
Got it. Let's quickly revisit some earlier distinctions, focusing on instruments. Money versus capital markets again. Money markets. Short-term debt. Treasury bills. Commercial paper. Certificates of deposit. Interbank loans. Maturity under a year. Capital markets. Long-term debt. Bonds and equity stocks. Maturity over a year or perpetual stocks.
Short debt versus long debt and ownership. Primary versus secondary markets, the intermediaries.
Primary. Underwriters. Investment banks. Help issue new securities, advise, guarantee sales, direct or indirect. Secondary. Brokers, agents earn commission, and dealers, principals earn spread, facilitate trading of existing securities. Exchanges provide the platform.
Helpers for new issues versus helpers for trading existing ones, and the flow of funds between money and capital markets.
Driven by yield and cost, investors shift funds between them, seeking the best risk-adjusted return. If short-term rates rise, money might flow from capital to money markets and vice versa. Borrowers choose the market offering the lowest cost of funds for their needs, short-term borrowing in money markets, long-term in capital markets. It's a dynamic flow.
Constant search for best return and lowest cost. Okay, moving internationally now. Euro currency markets. Currencies held outside their home country.
Exactly. Offshore banking markets. Deposits and loans in a currency held in banks outside the currency's issuing country. Eurodollars, USD outside the US, are the classic example. Key feature. They operate largely outside the home country's regulations.
Why did the Eurodollar market emerge in the 50s?
Several reasons. Post-war European recovery, currency convertibility, U.S. investment in Europe. A big one was Regulation Q in the U.S., which limited interest banks could pay on short-term deposits. European banks could pay interest, attracting dollars. Lower reserve requirements outside the U.S. helped too. And Cold War politics, the Soviet Union preferred holding dollars in Europe, fearing U.S. seizure. Started with dollars, expanded to other currencies, euro currencies, and spread globally.
Regulation differences in politics played a big role. Main features of these markets.
Highly efficient fund transfer, largely unregulated, competitive with national markets. Pricing often based on LIBOR, driven by supply and demand, with rates potentially differing from national markets due to regulation. Closely linked to FX swap markets. Communication tech, crucial for growth.
Efficient, unregulated, global. How are euro currencies created?
Simple ways. Deposit currency in a bank outside its home country. USD in London equals Eurodollars. Or banks transfer deposits between themselves internationally. Key. Involves the bank. Bank is outside the currency's home country. Transferring funds from a US bank to a London bank is the classic example. Doesn't change total global USD deposits immediately, but increases money velocity. Lending by Eurobanks can then create more deposits, similar to domestic banking, but potentially without a different multiplier effect due to lower reserves. London and New York are major hubs, but it's a global network. International banking facilities, IBFs, in the U.S. brought some activity back.
Offshore deposit creation and lending.
Okay.
I like the long-term side. International bond markets. What are they?
Debt issued by companies, governments, or institutions sold outside the issuer's home country. Allows borrowing in foreign currencies. Three main types. Foreign bonds, euro bonds, global bonds.
Foreign bonds.
Issued in one specific foreign market in that market's currency, subject to that market's rules. Example, a Turkish company issues yen bonds in Japan.
Okay. Euro bonds.
Issued simultaneously in multiple countries in a currency different from where they're sold. Often bearer bonds, anonymous, tax exempt, traded OTC mostly. Aimed at institutions. USD historically dominant, but less so now. Seen as the long-term counterpart to the euro currency market, driven by regulatory differences.
Multi-country, foreign currency, often anonymous. Global bonds.
A type of euro bonds sold simultaneously in many countries, including the issuer's home market, like the US, and internationally. They are registered securities, unlike many euro bonds. Designed for very large funding needs, broad investor reach. Offer high liquidity, potentially lower cost despite registration. World Bank pioneered them in '89. International bond borrowing itself has a long history, back centuries.
Super euro bonds, registered, massive scale. What are currency option bonds?
Give the bondholder the choice of which currency from a preset list to receive principal and interest in. Exchange rates between these currencies are fixed at issuance. Mitigates currency risk for the holder. They can pick the strongest currency at payment time.
Investor chooses the currency.
Good.
Lever, issuance costs.
Commissions paid to underwriters. Higher for longer maturity bonds. Usually a percentage of the issue amount deducted upfront.
Longer term, higher fee. Syndication and market challenges.
Euro bond syndication, group of banks selling the issue can be less formal. Lead underwriter often manages price stabilization initially. Challenges compared to stocks include less trading transparency, more OTC, potential liquidity issues for smaller players, and slower price reaction to niche bond prices, more driven by macro factors like interest rates and inflation.
Less transparent, maybe less liquid, slower reaction than stocks. Okay, international equity markets. How do companies sell stock abroad?
Several ways. Foreign stock issuance, selling shares directly in a foreign market in local currency listed on the local exchange. Good for companies with international operations. Dual listing, listing on home and foreign exchanges to boost liquidity and capital raising potential.
How can we buy foreign stocks?
Direct purchase on foreign exchanges complex for individuals. Custody, tax. Through domestic brokers with international access, simpler but still involves complexities. Most common for individuals. Investment funds, mutual funds. Pool money, professionals manage diversified portfolios of foreign stocks.
Funds are the easiest route. Types of funds.
Global, domestic plus foreign, international, non-U.S. only, emerging market, regional, country-specific, like a Turkey fund, specialty, sector-focused, privatizations. Open-end funds can issue new shares based on demand.
Lots of fund options. Finally, international financial regulation and integration, plus Basel Accords. Key regulatory principles.
Home country control. Home regulator oversees foreign branches. Mutual recognition. Countries accept each other's rules. Minimum harmonization. Coordinating essential standards. Full harmonization could boost integration, but might affect diversification. National treatment. Treat foreign firms like domestic ones. Key for trade, less applied in finance. EU integration shows patterns. M&A helps integration. But challenges remain. Different tax rules, dispute resolution, consumer protection, accounting, bankruptcy laws hinder deeper integration.
Balancing cross-border ease with national rules. Now, Basel Accords for banking. Why Basel II after Basel I?
Basel II was a more comprehensive, risk-sensitive update. Basel I focused mainly on credit risk. Basel II aimed to explicitly capture other major risks like operational risk, errors, fraud, system failures, and interest rate risk in the banking book, impact on non-trading activities. Goal, a more stable system by better reflecting banks' true risk profile.
Broader risk coverage. Implementation timeline. EU alignment.
Developed late 90s, early Lordy years. Aimed for G10 implementation in 2006, others from 2007. EU aligned its own capital rules, Capital Requirements Directive, closely with Basel II, meaning internationally active EU banks faced increased requirements, especially for operational risk and public disclosure.
Global push towards these standards. The 3 pillars and advanced approaches.
Pillar 1, minimum capital requirements, refined credit risk, added operational risk. Pillar 2, supervisory review process, more regulatory oversight. Pillar 3, market discipline, enhanced public disclosure. Basel II also allowed sophisticated banks to use their own internal models, advanced approaches for risk assessment, using data like probability of default, loss given default, etc., potentially leading to more risk-sensitive capital levels. Overall impact expected to be a slight reduction in total system capital, but more variation between banks based on risk.
More tailored capital based on internal risk assessment. Wow. Okay, that was an incredibly comprehensive journey through financial markets and institutions. We covered a massive amount of ground.
We really did. From the absolute basics of primary and secondary markets right through to the intricacies of Eurobonds and Basel II. What's really striking, I think, is seeing how interconnected it all is. Nothing exists in isolation.
Absolutely. And for me, maybe the aha moment was seeing how things like the Eurodollar market evolved almost accidentally, driven by regulations like Regulation Q and even Cold War concerns. History shapes finance in unexpected ways.
That's a great point. It's not always a grand design. Sometimes it's adaptation and finding ways around rules.
So for you, our listener, who gave us all this rich material to work with, we really hope this deep dive has helped paint a clearer picture, making sense of the markets, the players like banks and central banks, the different instruments, and those big forces shaping global finance and regulation.
It is a complex world, no doubt, but hopefully understanding these core concepts makes it less intimidating. It helps you follow economic news and maybe even think about investment opportunities differently.
Definitely. And perhaps a final thought to leave you with.
Yeah, something to mull over. Given this increasing interconnectedness we've discussed and the rapid pace of technological change, fintech, digital currencies, how might future financial crises or just the general nature of markets look different from what we've seen in the past? What's the next big transformation?
That's a fascinating question, something for all of us to keep thinking about as this world continues to evolve.